Imagine you are watching a cricket match. The pitch starts out flat. Batters are scoring freely. Suddenly, it turns bouncy and bowlers take the charge. Then, just as quickly, it flattens again. Each change affects the game differently. That's exactly how volatility shapes the market. If you have ever wondered why some stocks swing wildly while others stay calm, the answer lies in the volatility. But here is a twist: volatility isn't just one thing, it comes in three forms, and most traders have no idea about it. Let's fix that today. Today, I'll walk you through what I called is the three circle of volatility. Number one, market volatility, the big picture. Number two, non-event volatility, the stock's daily rhythm. And number three, event volatility. This is the game changer. Understand these three things and you will see why options are priced the way they are, and more importantly, how to trade smarter. Let's start with first, market volatility, the bigger picture. Now, think of a stock market as a cricket stadium. When the pitch becomes unpredictable, every player is impacted. So, for example, if the market crashes, most of the stocks fall, regardless of their fundamentals. This is market volatility. It overhangs everything. So, what is the key insight? The key insight is if it is a high market volatility, then there will be expensive options. If the volatility is low, the options will be cheaper. Knowing this helps you to time your entries better. Number two, non-event volatility. Now this is stock's natural rhythm. Let's zoom in. Non-event volatility is how a stock moves on a day-to-day based upon its own behavior. So for example, an HDFC stock might move 1 to 2% daily, maybe calm and stable. Whereas ICICI moves 3 to 4% daily, more aggressive than HDFC. So what is the key insight here? Every stock has its own volatility fingerprint. This helps you to choose the right strategy even when the market is quiet. And number three, event volatility. Now this is what I called as a game changer. Now comes the most explosive circle, event volatility. What triggers it? Let's say quarterly results, product launches, regulatory changes, shareholder votes, and so on. So for example, imagine a stock option expiring in 10 days. The market predicts it will move 10% before expiry. But guess what? Most of the moves might happen on day 5 during the earnings or results. So if you understand event volatility, you can trade specific moments, buying ahead of the spike and selling into it. That's how pros profit from volatility, not just the price direction. Now, why this matters for traders? Understanding these three circles of volatility gives you an unfair advantage. You start identifying those opportunities which others missed. You start trading on volatility instead of price. You avoid overpaying when the volatility is inflated. You start using event-based trades to make profit out of earning, product launches, and more. So, final thought. Average traders look at the price. Smart traders, they trade volatility. Once you start seeing these patterns, your entire approach to the trading will shift. Now let's test our understanding with a quick quiz. Question number 1. What is the first circle of volatility discussed in this video? Option A, non-event volatility. Option B, event volatility. Option C, market volatility. Or is it option D, trading volatility? You guessed it correctly. The answer is option C, market volatility. Question number 2. How does market volatility affect stocks? Option A. It only affects stocks that have low volume. Option B. It overhangs all stocks, making them move similarly when the market crashes. Or is it option C? It only affects large cap stocks. Option D. It causes stocks to be less affected by external events. The answer is option B. It overhangs all stocks, making them move similarly when the market crashes. Question number 3. What is the non-event volatility driven by? Option A. Global news and market trends. Option B. Overall market sentiment. Option C. A company's fundamental and regular movements. Or is it option D? Short-term events like product launches. The answer is option C. A company's fundamental and regular movements. Question number 4. What is an example of event volatility? Option A. A stock's regular daily movement based on its fundamental. Or option B. A market-wide crash affecting all stocks equally. Option C. Events like quarterly results or product launches causing massive price swings. Or is it option D? Long-term market trends that affect stocks movement. The answer is option C. Events like quarterly results or product launches causing massive price swings. Last but not least, question number 5. What can you predict by understanding the 3 circles of volatility? The overall stock market performance. Option B. How stocks behave during the major events like earning. Option C. The exact movement of every stock in the market. Option D. Whether a stock will go up or whether it will go down. The answer is option B. How stocks behave during the major events like earning. Drop your quiz score in the comment. I'll personally check and guide you as you build your edge. If you found this valuable, share it with someone who is still trading options without understanding the volatility types. In the next lesson, we'll be learning how IV and RV together build and probability driven profitable trades. Until then, keep learning, keep winning.